Seema, you will let me know.
Yes, sir.
Good evening.
Good evening. Good evening. Okay.
Hi.
Yeah, I can see you, Mr. Subramanian. We can start now.
Yeah, in fact, there was some problem. I used the earlier link. I logged in at 4:59.
Oh,
Nobody
I
was
see.
there.
Yeah, I'm sorry, we were connected, so there must be some problem with the connectivity. So thank you very much, and we will start. My name is Sandeep Singh. Today we had our AGM, so I'm the outgoing president of ICEMA. Are you able to hear me?
Yeah. Now we can hear you, Sandeep.
Yes, please.
Okay, fine.
Okay. We are going to have a session on opportunities for Indian sea industry in rapidly evolving economic environment. Good evening, dear friends, industry colleagues, and all these distinguished delegates who have joined us virtually today. On behalf of Indian Construction Equipment Manufacturer Association, it is my pleasure in welcoming Dr. Krishnamurthy Subramanian, Chief Economic Advisor, Government of India, as the guest of honor of ICEMA Annual Session 2021. Thank you, sir, for your esteemed presence. We look forward to your address. Over the last 1.5 years, the unprecedented impact of COVID-19 has been felt all over the world, including India. And just when India was recovering from the first wave of pandemic, the severe second wave hit us, taking its toll on human lives and disrupting economic recovery. The Indian construction equipment industry, being an integral part of the manufacturing sector, has also been severely impacted. And during the second wave, the Indian construction equipment industry witnessed 50% decline in volume in the first quarter, though it was not as bad as the last year, but in the first quarter, in the first 3 months of this financial year. However, the state lockdown being relaxed gradually and the government's enhanced focus on infrastructure, we are confident that the construction equipment industry will witness a revival in demand and play an integral role in reviving economic growth of our country. With the objective of making India the manufacturing and export hub for construction equipment, we have partnered with BCG to frame the Sea Industry Vision Plan 2030. The industry vision plan envisions the sea industry to grow 3 times in current size in the next 10 years, become the second largest sea industry in the world. We have potential for that, and establish ourselves as the manufacturing and export hub of the world. We are confident that the government's enhanced focus on infrastructure development and key initiatives such as creation of development finance institution for infrastructure financing will help and drive infrastructure and construction activities in India, accelerating the revival of Indian economic growth. The Sea Industry Vision Plan 2030 also aligns itself to the government Atmanirbhar Bharat initiative by focusing on indigenization. Here, I would especially like to mention that sea industry seeks from the government incentive schemes such as PLI to enable to develop indigenous technologies and capabilities aimed at reducing its import dependence. I am sure that with the help of government policies aimed at reviving economic growth and creating a conducive business environment, the Indian sea industry will achieve its Vision Plan 2030 and contribute to Indian transition to becoming $5 trillion economy. I now invite Dr. Krishnamurthy Subramanian, to Chief Economic Advisor, Government India, for his address. And post that, I would like also to introduce Siddharth Zarabi, Managing Editor, Business Today, to moderate this session today. So thank you very much, Siddharth, for joining us today.
Thank you so much.
Over to Mr. Subramanian.
Very good evening, and thank you very much to ICEMA for inviting me to share my thoughts. I'll keep my thoughts brief in terms of so I'll try and cover three main areas. One, look at how the economy did over the last 1 year. What is the impact of second wave, and also then talk about economic prospects for the next few years and for this decade at large. So firstly, if we look at the economic performance over the last 1 year, and you would all recall that the first quarter, because of the national lockdown, there was a significant decline, 24.4% decline in the GDP. And those of you who track my media interactions would have noted that during my press conference then, I had mentioned that there is a V-shaped recovery that is on. I was the first to say that at that time. And indeed, if you look at the GDP growth and other macroeconomic parameters over the last 1 year, you indeed see a V-shaped recovery. GDP growth itself, after that decline, 7.5% for the second quarter, 0.4% for the third quarter, and 1.6% for the fourth quarter. 0.4% for the third quarter and 1.6% for the fourth quarter. If you look at the gross value added, which is a better indicator for the third and fourth quarters, because the identity that links them is that GDP is equal to the GVA plus taxes minus subsidies. And because subsidies were large last year, given the pandemic itself and the backloading of subsidies and the change in the accounting norms with all the off-balance sheet items being brought on balance sheet, the change in gross value added is a better indicator for the third and the fourth quarter, which recorded 1.6 and 3.7% growth respectively. So if we take the appropriate measure, we can say after having declined by 24.4%, then a much lower 7.5%, the economy effectively grew at around 1.6% for the third quarter and 3.7% for the fourth quarter. And this is being seen actually in a lot of high frequency indicators. My office tracks almost 60 high frequency indicators, precisely 58 about, and that is how we actually assess how the economy is going. And it's that kind of assessing that actually helped us to predict that there is a V-shaped recovery in the macroeconomy. During the Q&A, of course, we can have discussion about some of the nuances, possibly across sectors and maybe across different income groups, etc. But at the macroeconomic level, the first lesson to take away was that there has been a V-shaped recovery, and that is something that we are very happy that what we had assessed has indeed transpired. A more important aspect that actually I want to look at is while the 7.3% for the year was 70 basis points better than the revised estimate of 8%, what is quite important to notice is the second half of the last year, especially the fourth quarter, and this is from the perspective of your industry in particular. So if you look at the gross fixed capital formation in the economy, the GFCF, it grew at almost 30%, 28.4% to be precise. And the ratio of gross fixed capital formation to GDP, this is basically a proxy that we economists use for the investment rate in the economy, was at a 26-quarter high. In other words, a high for the highest in the last 6.5 years. And that is something because that has resulted because of the infrastructure push that the government is doing, the economic recovery through the infrastructure push. And we've covered this in the economic survey, but I will reiterate again that Capital expenditure, the fiscal multipliers are much higher. Fiscal multiplier is basically jargon for, how much return do you get from investing 1 rupee in the economy. If the government puts in 1 rupee, how much does the economy get, how much that gets added to the economy. Fiscal multipliers for capex are about 4.5. Over the life of the capex, with 2.5, about 2.2 to 2.5 coming in the same year, while revenue expenditure, the multiplier is less than 1. In other words, you spend a rupee and you add only about 90 paise to 96, 97 paise, in the economy, and therefore you actually there are deadweight costs that are created with revenue expenditure. Therefore, the emphasis on the capital expenditure driven push, which has been seen in the second half, especially fourth quarter, as I was saying. Gross fixed capital formation grew, at very high levels and was at a 26-quarter high. What were the impacts of these? First thing that actually happened was construction sector grew at 14.5%. So in a quarter where even if we take the GVA, which is 3.7%, if we take the GDP, it was 1.6%. The construction sector growing at 14.5%, so several multiples of either GVA growth or GDP growth. That's the first thing that happened because of the infrastructure push. As a result of that, two other key positive spillovers that manifested. One, consumption, which is your private final consumption expenditure, again in the economist jargon for consumption in the economy, grew at 2.7% after having declined for 3 consecutive quarters. And the contact sensitive sectors, travel, tourism, etc., after having registered degrowth in the high negative, in the double, in the high double digits, recorded a degrowth of only 2.3%. So these positive spillovers of the emphasis on capex and thereby on construction actually showed its impact on the ground, and that is something that is very important for us to take away. That this capital expenditure driven recovery that the government has emphasized, because of the greater bang for the buck that we get, in terms of the in performance on the economy, is indeed actually showing its impact. It had its anticipated impacts in the fourth quarter and overall in the second half itself. I think that's the first aspect that I want to mention overall, when we look at the last year's recovery. Now, the second part of my talk, which is the economic impact of the second wave. Overall, there are some very important distinctions that we must acknowledge. As we all know, over the last 1.5 years, economic fortunes have been linked very closely to the pandemics itself. So the second wave, from a health perspective, was of course very devastating. But the economic impact is likely to be much lower because of 2 or 3 key aspects, which I want to emphasize. Firstly, the second wave, the rise was very steep, and the decline has been as steep as well. Of course, there is some plateauing now at about 35,000 odd cases, but the decline actually from the peak of 4 lakh plus was equally steep as the rise itself. As a result, the duration of the second wave was about 6 to 8 weeks in terms of the really intense portion, while the first wave actually was much longer. Ended in September last year. So the duration itself was much smaller. That's point number one. Second, unlike in the first wave, when all countries were learning how to deal with the pandemic, a situation of extreme uncertainty, unknown unknowns, by the second wave, countries and states in India had figured out how to actually control this, and now there's some research coming in as well about how different states have done by imposing lockdowns, etc. So the restrictions that were put this time were at the state level. As a result of that, the restrictions were, number one, heterogeneous in terms of their intensity and asynchronous in terms of their timing. So, they were basically at different times. Not every state had restrictions at the same time. and they were different in their intensity as well. And as a result of that, economic activity did not get impacted as much. One more aspect was that essentials were not really impacted at all, and interstate movement continued as it was, before the second wave. So as a result of all these, when we look at the high frequency indicators from the second half of May onwards, they've started trending up. They actually declined in the month of May, especially not as much in April, but first half of May, first 2 weeks of May, there was a sharp decline, but have started going up. And so overall, we assess the economic impact of the second wave to be not very large. If you would recall, the budget had a projection of 10.5% growth, while the economic survey had 11% growth projected for this year. Many international agencies like the IMF, for instance, had projected at 12.5% growth. Compared to those projections, the projections in both the economic survey and the budget were far more conservative. As a result, even the small impact actually should not really be very, very large. So India should grow at a high rate this year, and that's the second part of my talk. Let me now talk about something that all of you would be very keen to know. What are the prospects for economic growth in the coming years and in this decade itself? In order to assess this, I think the first and foremost aspect that we all have to acknowledge is that there has been a slew of reforms in the last 1.5 years. And let's note very clearly here that India was the only country to launch these slew of reforms during the pandemic. Every other country, if you look at just the demand side measures, no reforms, no structural reforms. In contrast, India actually implemented a slew of reforms, whether it's labor reforms, the farm bill, the financial sector reforms, and we can talk about that in detail if there is, during the question and answer session, if people are interested. The president mentioned about the DFI. Apart from that, the privatization of public sector banks, the creation of VAT bank, increasing the limit for FDI in insurance to 74%. These are all very, very important steps. Together with that, the quite critical enterprise policy focused on the private sector. This is India effectively coming full circle in terms of its industrial policy. In the first industrial policy, the commanding heights of the economy were given to the public sector. Now, the commanding heights of the economy are basically being given to the private sector, with the government choosing to be in only a few select sectors. And this is something that actually now the Honorable Prime Minister has talked about in the floor of Parliament, in the budget session. And so not just the economy, but even the political economy is synchronized for this full circle and the commanding heights of the economy being taken by the private sector, which actually will bring efficiency gains and will also actually enhance investment rates. So when you put all these reforms together and think about growth rate, macroeconomically, it's driven by two things primarily, which is the investment rate in the economy and the and productivity in the economy. What we macroeconomists use as is basically the gross fixed capital formation to GDP ratio. That's your proxy for investment rate, and the incremental capital output ratio, ICOR, which is basically a proxy for the productivity. So these reforms will, number one, will enhance productivity, because when you have assets that are being, that have not been managed as well, and so the return on investment on those assets has not been as large, transferred to the hands of those that have better incentive, to be able to operate those assets, the productivity does improve in the economy. And this happened actually after liberalization as well, and especially during the before the 2009 period. Again, then when India grew at close to 8%, it was because of the very high investment rates, close to 40% investment rates that India had. So that's the other thing that will actually really manifest. If you look at the manufacturing sector PMI, for instance, the Purchasing Managers Index, from the month of September of last year, it continued to be in expansionary zone and hit eight-year highs in some of the months, except for 1 month. It actually every other month it was in an expansionary zone. That is actually indicative of the investment opportunities that there are in the manufacturing sector, because a lot of the reforms that have been done are primarily catered towards enhancing manufacturing. Here I will also mention the emphasis of capital expenditure on two key areas, which is roads and railways on the one hand to reduce logistics costs, and power to reduce the power costs, both of which are extremely critical for competitiveness on the manufacturing side, and of course especially for your industry as well. So when you put all these together and we've internally assessed, we anticipate the investment rate in the economy, which is your GFCF to GDP ratio, getting closer to 40% in the years to come. We're projecting about 36% in three years or so from now, and accelerating further. So we anticipate that from FY23 onwards, India should be able to hit a growth rate between 6.5% to 7% in FY23, and then accelerate further as the full impact of these reforms will start manifesting. And I'll conclude with this observation that even after the 1991 reforms, there was some, it took some time for the impact of those reforms to manifest. There's, I'm reminded of this interview that the Prime Minister who did the reforms, PV Narasimha Rao, talking about when he was the press person mentioned about what do you feel about the 7.5% growth that India is getting. So he responds back by saying, how did that happen? What do you think made it happen? He said it was liberalization, the reforms that were done. So similarly, I'm very confident that 4-5 years later, when history looks back at this period, history will indeed record that these reforms were as seminal as the reforms that were done during liberalization, because these are all factor market reforms. And political economy, in fact, actually really clearly demonstrates that democracy factor market reforms are much harder to do than product market reforms. And so the hard things have been done in these during the last 1.5 years, and India has really utilized the crisis to reform, to really implement a lot of reforms which will bring growth. And so I have no doubt that this decade will be a decade of high growth for India. I'll stop there and thank you for your kind attention.
Thank you very much. Really, thank you for your encouraging words, remarks, and highlighting the key features of the economy. Now I will switch over to Siddharth, and Siddharth, I would like you to now start question and answer session. I'm sure many of our colleagues will have very pertinent questions over the economy, especially related to our industry. So over to Siddharth. Thank you very much.
Thank you very much, and a very warm welcome to be having this discussion on a very rainy day. The monsoons have arrived in New Delhi, and the monsoon session has also started. And Dr. Subramanian, it's a pleasure after a considerable gap to be talking to you on a screen once again. Wonderful points made by the Chief Economic Advisor, and I think all of you here must have taken note of that point that he made about reforms and the political economy now being synchronized for and with the private sector. I think that's a very seminal statement, and it tells you the amount of the deep shift that has taken in place as far as the policy approach of the government of India is concerned. And I completely agree with the CEA that while there could be, in my view, near-term sort of issues or struggles or challenges, I think in the medium and long term, we are on an upward trajectory. And I have a few questions that we have time for. I'm going to begin before I invite a couple of the members of the Governing Council here to ask their questions. Dr. Subramanian, I want you to sort of explain for all those who are here about in as simple terms as you could, by when do you really think we could go back to a high growth era? You remember the days of heady growth, they were accompanied by inflation, but let's leave that aside. Purely from a sentiment and from a public point of view, high growth, which also was seen as contributing to high job growth and high income growth. When do you see that return taking place? How much time in your view? So you'll have to unmute yourself.
This year, Siddharth, so as I already covered in my opening remarks, we will grow at a high rate this year. Of course, this year's growth will be from a lower base. But next year, as I said, FY23, we anticipate between 6.5% to 7%. And from there on, growth accelerating even further. So, in terms of, if you just go by the pure numbers, from this year onwards, we should have high growth, moderated a little bit by next year by maybe between 6.5% to 7%, but then increasing beyond that. Now, you mentioned about inflation, and I actually want to take this opportunity to highlight, and for the benefit of those that who want to know more, I had written a piece in the Economic Times a few months back about the difference in the policy response. I contrasted the current crisis induced by the pandemic, the global financial crisis, and the Asian financial crisis, which are the three crises that the Indian economy has had over the last 20 odd years. And I had highlighted the important lessons that we took away from the policy response to the global financial crisis, the mistakes to avoid, and the key learnings from the Asian financial crisis, the successful formula that was implemented at that time. And if you recall, Asian financial crisis, after that, the entire capex was increased, the golden quadrilateral was built, for instance, at that time, and reforms were done at that time. The entire telecom revolution happened after the opening up of that sector. Similarly, small scale reservations were removed, privatization was embarked upon, and we know the growth that we got. In fact, the 2004 to 2009 period growth was essentially a momentum from the reforms that were done at that point in time. In contrast, after the global financial crisis, the response was primarily revenue expenditure driven. As a result, what happened is the economy did not get enough bang for the buck. And you had runaway inflation and this is just sort of basic economics, where if you take a demand supply curve, if you actually increase demand but you do not increase supply, then you will have runaway inflation, which is what happened. And all the facts and figures actually are there in that article. I would encourage all of you to focus on that. Similarly, this time as well, we have focused on supply side reforms, because emerging countries like ours, supply side frictions are really biting. And so when you do not have supply side reforms, but you just increase revenue expenditure, the triple whammy of which is what led to the taper tantrum, with high fiscal deficit, high current account deficit, about 6%, and runaway inflation is what led to the taper tantrum. In contrast, now I do not anticipate, because of some of the temporary supply side aspects due to the economic restrictions, inflation has been a touch lower, has been a touch higher, but I don't anticipate inflation to be a problem, because when you create growth by working on the supply side, and as Sales Law says, that basically, especially to the construction sector, creates jobs and thereby demand, you get growth without actually having very high inflation. In fact, the other related point is when you actually have supply side pushing it, monetary policy and fiscal policy can be working together rather than working at cross purposes, which is what happened after the global financial crisis. Because when you have high inflation, monetary policy has to undo, the demand push that has been given by fiscal policy. So I think this is an important aspect. I do want to highlight that growth, should happen without runaway inflation.
Wonderful points that you make there. Very quick follow-ups before I go to the first question from the council. You mentioned about the economic survey estimate for growth as well as the budget and the IMF projections. I just want to ask you, what do you think 4 months into the financial year and 3 months after a devastating pandemic, will the economic survey target for GDP growth in the current financial year be exceeded or met?
You posed it as an asymmetric question there, I must say. Let me respond by saying that we will be in that ballpark.
Okay, wonderful. I don't want to take too much time on only discussing macroeconomics because we have some senior industry figures here, and it's always great to get policymakers and industry executives talking. So the first question, I'm going to go to Mr. Deepak Garg, Managing Director of Sani Heavy Industry Private Limited. Mr. Garg, please ask your question. Keep it short so that we can fit in as much as possibly the time allows us. Mr. Garg, over to you. Please unmute your mic before you ask your question.
Thank you, Siddharth, and thank you, Mr. Subramanian, for sharing your views. It gives us a lot of comfort when you talk about infra push by the government and specifically that multiplier of 4.5 that you talked about. We have been seeing this enhanced fiscal spending on infrastructure to aid the economic revival. But however, with these repeated waves of pandemic, would the government be able to sustain higher infrastructure spends? And what might be some of the key trade-offs for the government in maintaining this higher infra spend? And what actually would be the implications for the CE industry, the entire ecosystem of MSMEs, bankers, NBFCs, who are, stakeholders of this entire CE industry?
So, Mr. Garg, let me be, state it emphatically that the budget targets that we have laid out for infrastructure spending, those will be adhered to. In fact, even on the fiscal deficit numbers, that we have projected, we will. I am absolutely confident that this year, we will meet those. If you recall, instead of 9.5% as in the revised estimate, fiscal deficit for last year, we ended it at 9.2%. So, this year as well, the 35% increase in capex that has been planned will indeed happen, and I see absolutely no issues there at all. In fact, and the Honorable Finance Minister has also mentioned that we would like to front load the capital expenditure spending now, so that the impact like we saw in the fourth quarter, those impacts manifesting again, construction activity growing, thereby, helping informal sector, jobs in the informal sector. So we would want those to be, so I don't foresee a problem at all on us meeting those estimates. I think that is the most important. In terms of the, the financing aspects, so, as you can see, we've not only, laid out this plan, macroeconomic plan for basically capex spending, but we also realize that financing is very important, and therefore, we do not want a repeat of the mistakes of the bank-led infrastructure, spending, which created this entire problem of bad assets, and therefore the development financial institution, the bill has been passed for creating a public sector DFI and also enabling private sector DFIs. So I think, the main lesson for all of you should be that, to not repeat the mistakes that we had after the, the global financial crisis. Again, mark my words, there will be a period 2.5 years later where, there is a possibility of irrational exuberance coming in. I think, industry folks have to always be careful about, not saying that, we're going to basically have 12-13% growth. That I think if you remember that the seeds for a crisis are always sown when, during good times. If you keep that in mind, I think, we will ensure that the growth is a sustained one and not one that actually where, you just clamp down on the accelerator and only to realize that now you have to, push on the brake. So I think do keep in mind that, and this will happen 2.5 years later or so, where you all may start feeling irrationally exuberant. Remember my words and keep in mind that the seeds of a crisis are oftentimes sown during good times.
Dr. Subramanian, is it possible for you to provide more granularity on when the DFI would perhaps be in a position to start a dispersal of low-cost funds? Have we reached that stage yet?
So I think this would be a question that is best addressed to the Secretary of Financial Services. The legislation has already been passed, and from what I understand, all the necessary steps are being taken to actually bring the entity into fruition.
Absolutely. Okay, let's go across to another question from the panel here. Mr. Vivekanand, who is the director of Caterpillar India, that's a brand that many people know. Mr. Vivekanand, if you can hear me, please switch on your speaker and microphone and go ahead and ask your question.
Yeah, thanks, Siddharth. I can hear you. Good evening, sir. I think it's very insightful and inspirational to hear your perspective on the economy, more so on the multiplier effect, what it really matters to us. And thanks for that. And I'm just wanting to ask some questions in the perspective of something beyond our country, because what is your view on the outlook of the geopolitical shifts based on what you have been seeing over the last 3 to 4 years, and how it will eventually shape up for the future? And what opportunities does it present to the CE industry as we are keen to establish ourselves as a global manufacturing hub for CE?
Vivekanandji, that's a very nice question. So the way I see, especially during the period after the global financial crisis and now the COVID crisis, I see a dichotomous separation into countries that are transparent, rule-following democracies, and opaque, not necessarily rule-following, non-democracies. So there will be this dichotomous separation, and so what we'll see is and it's already, I'm sure all of you are following, the events. You can see this sort of the grains on the sand, actually the sort of charts emerging, the pictures emerging in this direction. So for the construction industry, I would say that firstly, India itself actually is a very big opportunity, and I think the main aspect that I would focus on is that the construction industry should learn to become completely self-reliant. And let me emphasize here the difference between self-sufficient and self-reliant. Let me use a parallel. You show me a self-reliant individual, I can point out a capable individual. You show me a self-reliant company, I can show you a capable company. So building those competencies of being able to actually produce from, across the entire supply chain, across the entire value chain, I think is incredibly important. And that is really important in order to be able to be competitive, reduce costs, so that you can go and compete in the global markets. Because, be very, very clear that the only way to compete in global markets, there are only two ways. Either you supply the same product or service at a lower price, number one, or at the same price you supply a product or service at a higher quality. Those are the only two ways that I know of, and I'm sure all of you will agree. And the other aspect that I want to focus on is actually, don't be just myopic in your, this quarter's profits and maybe this year's. You have to have long run vision. Build today actually what you want to do, 3-4 years later. That's what vision is all about. That's what a leader is supposed to do, to really lay out that vision. So if you, today itself, seeing the way the geopolitics is shifting, if you can build in that and create that competencies to be able to be competitive, in the global and consistently provide, good quality products and services, you will create markets. And I think that is important. You can actually, given this dichotomy, focus on those, those countries which are more aligned with the Indian, Indian ethos and, the Indian, our own thinking as well. You could look for opportunities there, but you do have to keep in mind that global trade is a competitive field, where excuses don't sell.
That's a wonderful point that you make. Can I quickly just follow up on that point to also understand from you the shifts that are taking place in a global trade once the pandemic was at a peak, and then when there was other related developments in terms of India's place in the new trade order. Where do you think we should be playing on our strengths? And I ask this from the perspective that there are industry captains here who might want to hear your views from a policy point of view.
So, Siddharth, I'm not a foreign policy expert, but I will, just based on, understanding India, I can say that if there's one country that is enjoys a lot of trust across the Committee of Nations, it is India.
We'll wait for the CEA's link to be restored, as there seems to be some issues. Those of you are not logging into this session, who are not logged in from Delhi, we have had a bit of Mumbai today in Delhi. Delhi has witnessed rains like not never before, but at least not like this year. And it is completely coincidental that the monsoon session of Parliament started today, and the heaviest downpour of the season, including last year, in my view, has also happened today. So that's led to a lot of problems. I'm also working from home today as a result, because I live in an area where the fastest real estate construction is happening in Delhi, which includes the new, what is called the new Pragati Maidan, or the new conference complex, and a new expressway to connect parts of Haryana where there's a lot of real estate development. And this is near the existing airport. And I can tell you, everything is dug up and everything is underwater today. So it's an amazing day. I'm not sure if there is a similar problem which has disrupted the CEA's connection, but we'll try and wait. I think we had time at best for another question, and I'm try and see if there is any update that is available with the organizers.
The CA has talked about capital expenditure, increase in capital expenditure on road, rail, and power, but that will be nullified with the increase in commodity prices, steel.
Oh, the CA is back. So the CA is back. His connection is restored. Yes. I was filling in for you. Go ahead, sir.
Yeah. So in fact, I had not put my name on question, but then this question came in my mind.
Go ahead, ask your question. Go ahead, ask your question.
It's a very good that, we are increasing our capital expenditure on road, rail, and power, which is a very good thing. And we are experiencing that when we see the demand in the market. But the issue what we are facing is the increase in the commodity prices like steel, cement, which is increasing the cost of the project. So that will nullify the, the advantage what we could have got as an industry or as a nation in economy.
Dr. Subramanian, could you
You
hear
want me
that
to
question?
respond? Oh, okay.
Yes.
So, this is an aspect of market economy where when demand goes up, prices go up. Global demand is increasing. The global economy this year is expected to have a growth rate of around 4.5%. So global demand actually for commodities, is increasing. And if you recall, before the global financial crisis, again, that was a period where, global demand was at a peak and, steel prices, cement prices, all of those actually increased significantly. So I think, if the expectation is of subsidies, etc., on these, I think that is something that does not actually, sit well with well-directed spending of the taxpayers' money. I think we have to be very, very clear about that. When you have actually, global growth going up, export opportunities increase, but at the same time, commodity prices will go up, and it is therefore for firms to actually manage this very well. I think, only in theory do we have this situation of having your cake and eating it too. In practice, either you can have your cake or eat it.
Anyway,
Well, that's
over to
that's
Siddharth, please.
that's a good point, and I think that's a good point on which to end this short but very effective session. Dr. Subramanian, around 300 members from industry were logged in at the peak of this session, and I guess they have taken several of the points that you mentioned for their own future strategies. I'm going to thank you for your time and your patience with us today, and I'm sure everybody here has enjoyed this session as much as I have moderating the question answer. Thank you very much for your time, and thank you to the members. I'm handing it back to the organizers for a summation.
So I will request my colleague, friend Dimitrov, to share your closing remarks.
Yeah, my name is Dimitrov Krishnan. I head the Volvo's construction equipment business. Dr. Subramanian, you said two things which will stay in my mind. First, there is a decade of growth ahead of us. This very well goes aligned with our Vision Plan 2030 that we as an association have made. And secondly, you also mentioned about having the full value chain of the product being created in the country so that we have the maximum value add, and hence we have a competitive advantage with the rest of the world. So it's really something, both of these points resonate with our Vision Plan 2030 because we want to create an industry which is growing with the infra focus that the country has got. We want to triple our industry size in 10 years. And also we want to be an export house and be the supplier of the world for construction equipment industry. Dr. Subramanian, it is an honor for me to propose this vote of thanks today. We are very grateful for you having spent your valuable time with us and sharing your insights on the global, domestic, and economic landscape. Your views on the importance of adopting a path of economic growth and addressing the pressures that come with this pursuit encourage us to overcome the challenges facing the construction equipment industry in achieving a growth potential. We assure you that the CE industry is committed in this direction. We intend to triple our growth, and I'm sure that the government's focus on infra will support us in this direction. Once again, sir, we thank you for engaging with us today, and we look forward to many more interactions with you in the times to come to help us align our growth plans to the nation's economic growth. Thank you very much, sir. And
Thank you. Thank you.
Thank
Bye-bye.
you.